On behalf of Spark Capital, I welcome you to the 4Q FY18 earnings call of Karur Vysya Bank. We have with us today the management team of KVB, represented by the MD and CEO, Mr. Seshadri, President and COO, Mr. Natarajan, General Manager and CFO, Mr. Sivarama Prasad, and Company Secretary, Mr. Srinivasa Rao. I now request Mr. Seshadri to take us through the highlights of the quarter gone by, after which we will open the floor for questions. Over to you, sir.
Thank you very much, Abhinesh. Thank you. Thank you all for joining the call. We greatly appreciate it. We are reasonably happy with what we managed to accomplish during the last quarter. During the last quarter, we've begun our transition to a more modern, more contemporary institution by starting the digital transformation process. Our first two fully digital products, algorithmically underwritten, fully paperless, went live. This is the home loan product. Arguably this is amongst the first within the industry as well, because even the loan contracts are paperless. And the working capital loan renewal product, most of you know that banks take a long time and take a lot of effort in renewing working capital lines. What we've done is essentially automated it and using a very, very predictive credit score. We now have line of sight to a series of new launches over the rest of the year. And the products have been well received internally as well as externally. So that makes us feel reasonably good. We are also working on upgrading our core banking platform. That process is underway. We've created a new dedicated asset sales force so that we can start pushing the retail sales a little bit more. We've started seeing a reasonable lift in our third-party product sales, which is, sales of insurance, investments, and so on and so forth. Our centralized collection facility went live in January of this year, and it is making a reasonable impact on the portfolio performance on the retail side. We intend to, over this quarter and early next quarter, start using that facility to call our commercial loans as well. As I had mentioned in the last call, we were in the process of hiring a chief risk officer. That process has now been completed. We are now in the process of creating a team around the chief risk officer. The chief risk officer is currently looking at various candidates whom we can hire so that we can build a world-class risk organization. And we have now started the process for creating analytics center of excellence so that we can then start using analytics as a method of improving the quality of the products and services that we offer. From a business standpoint, we crossed 100,000 crores some time ago. On a full year basis, our credit or the advances grew roughly 11%. But the highlight, as far as we are concerned, is that current account, savings account balances continue to grow. Current accounts grew at roughly 13% for the year, and savings account grew at roughly about 10%. On a cumulative basis, they grew approximately 11% year on year. We continued to show reasonable momentum on the pre-provision operating profit line, which grew at about 13% to end at 1,777 crores for the year. On a year-on-year basis, net interest income rose quite nicely, as did NIM. But the NIM increase had a one-time factor, net of which as well, our NIM grew about 4 basis points on a year-on-year basis. So I think, on a year-on-year, on a full-year basis, revenues grew to about 3,200 crores, which is about a 12% growth. Operating expense grew to about 11% to about 1,421 crores, leaving us with an operating profit of 1,777 crores. Other income, which is the non-interest income, grew nicely at 15% year-on-year. This is in spite of the fact that, income was sharply reduced during the year on account of the higher interest rates that we were facing. In spite of that, the other income line continues to be buoyant. On a quarterly basis, net interest income year-on-year grew about 11%. Other income shrank approximately 10%. But if you were to remove the difference in investment-related income, in Q4 of the prior year, we had about 78 crores on account of investment-related income. That dropped to only 8 crores during this quarter, and we, on other lines, made up approximately 46 crores. So total income grew 5% to 852 crores. That included a one-time revenue impact, which I mentioned a little earlier. Our operating expense grew 22% to 372 crores. That includes a 26 crore impact on account of gratuity change, which was taken into the P&L fully. Operating profit as a consequence was 480 crores for the quarter, down 5.33%. Provisions, and here's where, like many other banks, the stress on the credit side flowed through into our P&L as well. Total provisions were roughly 394 crores, 360 crores of which were credit-related, 34 crores were non-credit related, leading to a profit before tax of 86 crores, and net of tax about 51 crores for the quarter. On the provision side, I expect credit quality to be an object of significant debate during this call. I just wanted to clarify as to what our numbers held. We had total NPA of roughly 589 crores, of which 513 crores came from corporate, 63 crores from commercial, 11 crores from agriculture, and 2 crores from personal banking. On a net accretion basis, this implies a net accretion of 5.12% annualized, of which 14.25% was the net accretion on the corporate book, 1.56% was the net accretion on the commercial book, 0.56 was the accretion on agriculture, and 0.10 was the accretion on personal banking. A few quarters ago, we had said that, we are looking at approximately 1,200 crores of watch list. In the third quarter, roughly 550 crores of that watch list had flown through. During this quarter, another 325 crores of that watch list was marked as non-performing, leaving us with an incremental 325 yet to be provisioned. During this quarter, on account of the February 12 circular of the RBI, roughly 175 crores worth of assets were moved into the non-performing bucket. So that is pretty much it from my side, Abhinesh. I think the rest of it we could handle through the various questions that people undoubtedly will have.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Renish Bua from ICICI Securities. Please go ahead.
Oh, yeah. Hi, good morning, sir. Hello?
Good morning, Renish.
Good morning, Renish.
Yeah, hi, sir. So just a couple of questions. One on the our loan side. So, we have pretty much, digital platform in line, but what sort of team strength we have, or are we going to, hire people from outside, or, what is the plan to, push the retail loans apart from the digital platform?
So we are, we've come out with a series of ads. We are looking to hire a lot of people actually at senior stroke mid-management level.
Okay.
And we have a series of vacancies that we are contemplating addressing by fresh hires. So it's a little difficult to give you the full details on this call, but we have a long list of names. I mean, from folks who will manage our call center to sales managers who will run our retail book. All of those need to be hired and brought in from outside because that skill set we don't really possess inside the company.
Right. So basically just wanted to get the sense that we are in the process of strengthening the management team also apart from the platform, right?
Yes. So we are strengthening the management team. As I said the last time around, we wanted to first fix the credit processes. So we've hired the chief risk officer.
Right.
We will hire now a retail risk head. We want a risk analytics person to come in. And then together with that, a series of other openings we have declared already. And we've advertised. We've got a lot of people who have come in and applied. We're also going through headhunters. So over this quarter, or early next quarter, we should finish the hiring process, actually.
Right. So just a follow-up on that, what I understand from this, conversation is that FY19 would be more of a consolidation year for us in terms of the loan growth, right? Because we'll be in the process of setting up the team and, platform and everything. And we are also upgrading the core banking system. So, all that will impact on the growth also. So what sort of advanced growth you target?
So I've been consistently mentioning that, from our point of view, we want to grow our loan book at market. We don't want to grow faster than market, but we want to grow our spreads. We believe that we are leaving money on the table and that there is spreads to be had in the customer sets that we are addressing.
Right.
So our focus will be to grow at market. I think we've grown at 11%. I suspect that that is pretty much, I don't know. I mean, what was the market growth rate? I suspect it would be similar to this.
Right.
But going forward, I think our own view is that we will grow a little faster than where we are at today because some of the structural impediments that we've had to grow are being removed as we speak. The digital platform enables us to do more home loans, for instance.
Right.
And the new, as and when the other products are introduced on the digital platform, we will get more loans done because of the fact that it is easier to do them. Right. Even though we will not have a full-fledged sales force like the ones that Kotak and ICICI and all have, even without that, we'll be a little bit more productive. So our growth rate will be north of where we are today. But it will we don't want to be in the 25-26% range of some of the other new generation banks. So we'll be happier in the 15-17% growth rate. But I think we have the technical capability now to get there.
Right. Yes, sir. So, since we need to invest more on the OPEX side, so in current year P&L, how much of the cost we have already, taken and how much it will impact in FY19?
From a cost perspective, we are working on it. As you can see, our cost has grown about 11% year on year.
Right.
And roughly 22% in this quarter.
Correct.
Now, if you were to remove the one-time impact of the gratuity change, we are closer to 16% growth
on
in this
QOQ.
Quarter on
right.
QOQ, right?
Correct.
Now, 16 is not a sustainable growth rate if your total income is growing at, let us say, 10 or 12 or 15%. I mean, we need to keep the growth rate on the expense side lower than the revenue growth rate.
Right.
So we are working on reducing expenses in areas where there is buffer available. And we now have an expense task force that is looking at it. So your question was, what is the cost of the new systems that we have?
Right.
The cost of the new systems, very strange, given our expense base, which is roughly about 1,500 crores, the cost of the new system will be about 1.5% to 2%.
Okay.
Flowing through. It will be that would be the total cost of the new technology that is coming on board. It's not a very material difference to our total cost base.
Right. So you are saying 30-40 crore, or maybe 20 to 30 crore might add due to this new system.
Correct.
In FY19.
The addition will come in terms of incremental people that we will hire.
Right.
But that we are trying to ensure that we can keep contained by a cost-cutting measure.
Okay. So is it fair to assume that cost-to-income ratio, even on a best case scenario might remain flat YOY basis?
It is better to assume that cost-to-income ratio will deteriorate.
Okay.
It is better. Huh?
Okay.
It is 10% maintained, Renish, at 44 level.
Mm-hmm.
No, we've been consistently saying that there will be pressure on the cost side, and that remains the case going forward as well.
Okay, yeah. Thanks a lot, sir. That's it from my side. Thank you, sir.
Thank you.
Thank you, Renish.
Thank you. The next question is from the line of Rakesh Jhunjhunwala from Rare Enterprises. Also, we would like to remind participants that you may press star and want to ask a question.
How much is the gratuity provision in the last quarter?
Sorry, Rakesh, could you repeat that question, please?
How much is the gratuity provision, one-time gratuity provision?
One-time gratuity provision was 26 crores, Rakesh.
I want to ask you about your growth.
Sorry to interrupt, Mr. Jhunjhunwala. Sir, we are not able to hear you clearly.
I'm sorry for that. Now, hello?
Yeah, go ahead, Rakesh.
See, this growth which you say 15 to 17%, what I would interpret is that you want to say you want to take risk-adjusted growth. For you, risk is as important as growth, isn't it right?
Absolutely. I mean, we want to ensure that
if you can contain your risk within your parameters, you could hope for much larger growth.
That is absolutely right, Rakesh. And
that will only be known after you set up after you automate the bank. Then only will you be able to know how good your risk containment measures are.
That is absolutely right, Rakesh.
How the external environment is. So I think would it be right to say that your growth will be a function of how good your risk containment measures are and how good the external environment is?
That is absolutely right, Rakesh. I couldn't
have
said it.
Instead of thinking in terms of percentages, let us think in terms of opportunity and our tapping.
I would completely agree with you, Rakesh. Now that we've got, scientific or mathematical tools to measure risk, we are seeing the kind of risk that is coming through the door, and we're also able to ensure that we get higher quality assets onto our book. As the new systems roll out to cover a wider range of our products, we will be able to then optimize on the risk that is coming into the book. Today, because of the old method of underwriting, it's the judgmental method. You know that one loan is more risky than the other, but you don't know by how much. With the decent scorecards, you can actually look at your population and see how the population of the new loans is doing and whether the ab initio quality of underwriting is better or worse. So you're making a very, very valid point. We need to get our systems in place, and we are trying to ensure that we remain a little bit more, conservative at this point in time. As the new systems, become available, we can then moderate our growth accordingly. So the good news is over the last 6 months, the focus on sales and focus on processes has definitely improved our ability to underwrite credit. But the quality credit parameters will be driven by the new systems, and that's why we are moderating ourselves to about 15-16% right now. And as these systems get embedded, we can grow much more quickly going forward.
And are there any major? So therefore, I totally agree with you that the first task has to be improve the process and systems, rather than trying to have the growth without the process and systems, which could lead to a lot of problems. Another question that I had is that are you seeing any major recovery in the NCLT cases?
We expect, we are seeing some, Rakesh, in the steel-related industries, as you're aware, there's already been one case that's been settled. There are others in the same industry that hopefully will get settled very soon. So there will be some amount of recovery that will start taking the pressure off the GNPA numbers that we currently have. So we are hopeful that before the fourth quarter, before the end of the year, our total NCLT related loans, which are roughly about 1,200 crores, vast majority of them should be settled one way or the other. And, we are hoping that the total haircut would not exceed about 60%, in which case, the balance sheet could look quite different from what it is looking right now.
Okay, sir. Thank you.
Thank you very much, Rakesh.
Thank you, sir.
Thank you. The next question is on the line of Dhaval Gada from Sundaram Asset Management. Please go ahead.
Hi, sir. A couple of questions. First, could you talk a little bit about the lending rate environment for us in various segments, and which are segments where you're seeing, scope of improvement in lending rates? You mentioned earlier in the call that there are pockets where you're not pricing the risk when you have scope for improvement there. So could you talk of those segments, and could you talk of segments where there are pressures?
Okay. If you look at page 4, it gives you our distribution of our branches. We've got 205 branches in metros, 162 in urban areas, 300 in semi-urban, 47 in rural, and 85 in unbanked rural.
Yeah.
Now, we have a fairly large percentage of our branches in not the largest places in the country. And for instance, historically, the way we priced our product is that we have a standard product related rate, and we have not implemented a risk-based pricing matrix. Whilst there is some form of a risk-based pricing, it was not very finely graduated. Now, when you are lending, when you are underwriting a home loan, and let us say you're underwriting it in Madras,
yeah,
and you're underwriting a home loan in a place called Vellakoil, which is close to Karur. The two represent two different levels of risk. In Madras, your appraiser who is doing the appraisal of the property is likely to be from Madras. He understands the market. There are some forms of comparables available in Madras so that people can understand, what the likely valuation of that property will be. So appraisal quality tends to be better in the bigger places. But if you are writing a loan in Vellakoil, which is, 50 kilometers from Karur, which is our headquarters, the appraiser probably goes there from Coimbatore, doesn't know the place very well. He doesn't understand the market as well as somebody operating in Madras does. And consequently, the appraisal quality is a little questionable. So it is a little bit of a higher risk for me to underwrite a mortgage loan or a home loan in that place. There is also the fact that the competition in Vellakoil is significantly lower than in Chennai. So consequently, I think we can have a small premium that we attach to doing business in Vellakoil, which hitherto we have not done, and now we have started doing. Similarly, with the higher quality credit scores in place, the ability to understand the riskiness of the customer is better. So even though we now have only 2 products where the score is alive, we are already seeing the fact that the front-end salespeople are understanding that a particular customer is more risky and are willing to charge a higher price. So that sort of opens it up for us. So from that point of view, we believe that, our ability to price on a risk-based basis will improve with the new scored model coming into play. So both because of the fact that we have a network which is geographically spread, and in the areas where there is lesser competition, our ability to price a little higher, and also on account of the fact that we now have a credit scoring model which gives us relative riskiness of different parties, our ability to charge a higher price for the more risky entities will increase. So that's the reason why I'm saying that we have the ability to increase spread and increase NIM.
Sir, would the same thought be true for even the commercial segment, commercial banking piece?
Yes.
Okay.
Very much so.
Okay. And sir, could you talk about what's the average, weighted average portfolio yield for the commercial banking today versus couple of years earlier? I mean, like, how is it moved in the last 2 years? The lending yield, broadly.
Lending yield, I don't have it in the deck right
sure.
now.
Okay.
The lending yield has been coming off a little bit, but commercial banking is our is the richest book that we currently have.
Right.
The last I looked at it, it was north of about 1,200 basis points was the total price to the customer, which
right.
spread was about 500, 600 basis points on that book. That may have come off a little bit because this is based on memory at this point in time. But maybe in the next quarter we can, in the deck itself, we can include a slide which gives you the various yields of the various products so that this question is addressed in the investment.
Yeah, that would be very useful, sir. Yeah, thanks. And the other bit was, sir, while you said you were satisfied with the liability book, when if you look at the absolute growth in current account and saving account, it's been broadly stable. I'm excluding the demon year, but just even before that, the absolute increases have been very, very stable. So, I mean, just your thoughts on the momentum that you're seeing on the low cost deposit.
Okay, I urge you to move to page 12.
Yeah.
Our current account book, FY16 full year, was 4,000 crores of roughly of demand deposit. This is current account. 8,000 of time deposits. Savings accounts. It moved to 5,000 crores and 10,000 crores respectively. And now has moved to 6,000 crores and 11,000 crores respectively. This is all rounded up for the sake of presentation. And we've been growing at approximately 13.02%. Now, we haven't so far used differential pricing on this book at all. So our current accounts continue to be priced at 0 and savings accounts continue to be priced at 4%. This growth has come on account of opening more accounts and on account of ensuring that we service these customers as they come in through the door. So, a 10 or 12% growth is a reasonable growth, and the growth is coming not only in end of period numbers, it is also coming on averages. So, on an average basis, in fact, our growth, I don't know, we should publish the average growth as well. On an average basis, again, we are we are reasonably satisfied with how the growth has come. In July of this year, we will launch our full digital bank, which will be similar to what Standard Chartered is doing or what Kotak has done. It's there on our page. It's on page 7, the digital bank scheduled for July 18. If all goes well, we will get that going in July, and we think that should give us the next jump in low-cost deposit growth. And we'll also sort of, at that point in time, come back and do some limited advertising so that we can get the message across to our customers that not only are we a traditional institution, we're also a reasonably modern one, and we are in a position to, ensure that our customers of whatever age group they may be are adequately supported. So that's the strategy.
Okay.
Yeah?
Just last question on asset quality. So you mentioned that the watch list has come down by 325 crores. Just wanted to clarify, is the 525 S4A account in the watch list?
Yes, there were some 525 S4A accounts in the watch list.
So the 76 crore and the 79 crore as of March 18 are part of the watch list?
No. One second. Let me answer that question now. Our restructured book has reduced very dramatically, as you noticed.
Yes.
Now, I'm just going to that page. Just give me a minute.
Sure.
The total restructured book is now 262 crores. right?
Yeah.
Out of that 262 crores, the 525 account, that is the 76 crore account, is not a portion of, it doesn't find mention in the 262 crores. Okay?
Yeah.
So that is, 76 crores has to be added to 262 to get a full accounting of the entire restructured book. Out of this, the 325 crores left does not include any one of these accounts.
Okay. So the 325 is on top of these restructuring.
Correct.
Okay.
So you would have noticed that we've taken a lot of, from 800 and odd crores, we have come down to 262. Most of it is because of they've become NPA.
Right.
And much of that, many of these assets were part of the 1,200 crores and they've already flown. They've become NPA already. All right. Now, the 325 does not include this 262. And many of these accounts are impacted by the February 12th circular. And some of these accounts have not yet been classified as NPA because there is a record of recovery that exists as of the 31st of March. But we suspect that approximately 200 crores of this more will require provisioning in the near future on account of the February 12th circular, which has changed the behavior of our customers and the other banks who are dealing with them on account of the fact that the restructuring process was not fully complete. So there's another 200 crores there.
Right. So, and if I just squeeze in one more, what's the provision that's left on the standard stress book, like total this restructured book plus the 525 and S4 that you added? What would be the provisioning that is left on these that you've already done?
Let me answer that question differently. Our total gross NPA now is about 3,016 crores.
Correct.
Net provisioning is 1,091 crores.
Yeah.
So on the RBI mechanism of accounting for provision coverage ratio, we are at about 56.5% because it takes into account this technical write-off.
Yes.
Right?
Yes. Yeah.
Your method of reckoning, we are at about 36%.
38.
Whatever, 36, 38, whatever.
Yeah.
Right?
Yeah.
So now, we think that we should be closer to about 50-60% for it to be a reasonable number so that people don't start deducting from our gross capital, actually.
Correct.
So what we think is that over this quarter, the quarter that we are in right now, the rest of the corporate provisioning will flow through. We are at the tail or the rump of our provisioning problems. We are not changing the 1,200 crore number. So that will flow through this quarter. And as a consequence, the following quarters, we will revert to our normalized loss rate, which we have been always saying should be approximately 150 basis points on an annualized basis, which is 750 crores of NPA accretion on a 50,000 crore book on an annual basis.
Yeah.
And but we will need to increase this provisioning.
Correct.
To about 1,700, 1,800 crores or thereabouts at the current levels of gross NPA. But over the next 9 months or 12 months, we expect the gross NPA to also start coming off a little bit as the NCLT loans start, NCLT processes get completed and repayments start coming in. So we may not need to create another 700, 800 crores. We may need to create another 200, 300 crores worth of provisioning as we go forward, just to increase our PCR ratios.
Sure. Okay, sir. Great. All the best. Thank you.
Okay. Bye.
Thank you. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Thanks for the opportunity. Just a follow-up from the previous question, just to reconcile all the numbers. So currently we have 325 crores of stress book which is outside of the standard restructured, within which 200 crores is what we expect to slip in FY19. Would that be a correct statement?
No, 325 crores is a non-restructured book stressed. That's right. Right. There is another, out of this 260 odd crores worth of restructured asset, on account of the February 12th circular, we expect another 200 crores or so to slip in this quarter.
Okay. And so what would be your assessment for the 325 crores?
Sorry, I didn't get the question.
On the 325 crores of non-restructured stress, how do we see that portfolio behaving?
That includes a set of non-funded assets. The non-funded assets will, whilst we can make a preemptive provision against them, currently the process is that we are trying to see whether those non-funded assets are actually called upon for us to make the provision. So a portion of that, approximately 50%, we will, have to provide at a later date, other than for creating some kind of a preemptive provision. So it's difficult for me to put a date as to when all of that will flow through.
Okay. And so what's the quantum of non-fund-based assets within that, 325 crores?
Roughly 50%.
Roughly 50%. And so in the initial comment, you had alluded to that there was some one-time impact on the NII, which led to a NIM expansion. So just wanted to understand that. What was that one time?
One time was certain revenue receipts that are unlikely to be repeated.
Okay. So if you could give some quantification and some color, like what kind of revenue receipts?
I think it is computable. It is to the extent of roughly, it's actually computable from the information provided here, but yeah, roughly about 60 odd crores is a one-time revenue receipt.
Okay. And so with respect to the fee income, we have seen around 39% growth in the current year. And as I understand currently, we had taken some measures to realign our fee charges as well as some incremental focus on third-party distribution. So going into FY19, what kind of a fee income growth can we anticipate?
I think we are reasonably, we think that, we are leaving money on the table on the fee side as well, and that there is a reasonable amount of buoyancy on the fee line. That's our current belief. We think that with the new third-party sales force that we put into place, a new set of revenue streams can be started as well. So we are hopeful that as we go forward, the current momentum that we have continues, at least in the near term. We don't see any reason why the revenue momentum on fees should slack off.
Okay.
So if you look at it, our total revenue stream, fees are a small component of our total revenues.
Right.
In a sense, we are almost like a bank. I mean, we are like a non-bank finance company behaving like a bank. Our fee income stream is smaller than most other banks, so there is room for it to grow here.
So, lastly, on the digital implementation of products like working capital loan and home loans, as a renewal of working capital loan, so I just wanted to understand from the customer's point of view, how does the process change and what is the improvement in TAT or OPEX that we have brought in from the online renewal of working capital loans? And also on the home loan piece, with respect to the property, legal verification and all those, so how is that also built into the system or that happens separately outside the process? Post the implementation of the digital framework?
Very, very good question. On the digital side with home loans, the system can give you an informal sanction subject to, verification of your property and valuation appraisal in about 10 minutes. So earlier we used to do this in a day or two. Now it's gone down to 10 minutes. The system is also tied to our lawyers. So from the system itself, we can assign a case to a legal firm who in turn can give the legal opinion and title report, etc., directly to us through the system, so that it comes in without exchanging paper goes from our system to their system and comes back from there. Similarly, we are in the process of completing the hookup with the field verification entities and so on and so forth. So it's a full platform where everything can be done there, and the scorecard will run and score the application and approve it in 5-10 minutes. So we've gone from being a judgmental lender to one who's fully automated. On the working capital side, our renewal process used to take 1 day, 2 days. How long would it take?
Almost 4-5 days.
4 or 5 days. It used to take 4 or 5 days. Now we can do it in 30 minutes. That is essentially because the renewal is firstly scored using a scorecard. The customer is expected to put in his financials. He uploads his financials. We have software that reads his financials and understands his financials and puts it into the scorecard. He puts in his stock and other statements. The system again reads all of that and then figures out what kind of limit can be set, and can do this in half an hour. So the time taken for renewal has dropped from weeks to half an hour. Let's say a week to half an hour, and there is no paper movement. The customer can actually renew his account himself by putting in all his data into the system, or he could give the data to us in an assisted form. He could do the renewal. Now, the advantage of this system is not in the renewal side. The advantage of the system is when you are going to get new customers. The scorecard that we use for renewing customers can be used for acquiring new customers as well, because the same information can actually be accessed today. One of the drivers of the scorecard is the account statement, and the account statement from the other bank can be accessed today using tools like, entities like Perfios. And one of the big problems that banks like us have is that the effort required for doing a 50 lakh rupee loan and the effort required for doing a 5 crore rupee loan is roughly the same from a branch manager's point of view. So the branch manager ignores the 50 lakh rupee loan and does the 5 crore rupee loan. With the new system, the effort required for a 50 lakh rupee loan will be half an hour versus, 2 days of work for a 5 crore rupee loan. So consequently, we think that we will get significantly more smaller ticket, granular loans than we've got so far. And that's where the benefit will start accruing to us. We started with working capital renewal as against working capital new for the simple reason that renewal is a little bit more controlled and we have more information, and we wanted to ensure that the system works properly. The working capital new will come on board hopefully in August, and from then on I think our growth in business will shift to a different gear. And by then we will also be able to, in a position to see how well the scorecard is working, because we intend to use a scorecard which is similar to the one that we've used on our renewal, and we'll know how stable that is as well. So we are feeling reasonably comfortable at this point in time that the digital transformation will yield results as far as we are concerned.
Thanks a lot, sir.
Thank you. The next question is on the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity.
Hi Jay, how are you?
Yeah, I'm good, sir.
Go ahead, yeah.
Sir, just on this slide 8, where we are mentioning that now we have empowered our branch managers to meet customer needs immediately. If I see our peer banks, most of them have shifted to actually verticalization of different product, where branch manager has actually lesser power and is more of a service provider kind of a positioning. So, I mean, is it that, we are actually empowering more branch managers, and at the same time we are also saying that, most of the products are automated? So just wanted to understand, your views, or is the understanding correct?
So, you're making a very valid point. Historically, this institution has had highly empowered branch managers. Okay? So branch managers, we are one of the few places where the branches will still, offer services like letters of credit or guarantees at the branch, and these are not entirely centralized. What we are, that gives flexibility, and it also gives a level of customer service that, our competitors cannot give. So HDFC or Axis or ICICI cannot compete with us, because at the ground level, the guy is in a position to deliver services, which in their case will need to be referred several layers up or into a different location. Having said that, that exposes us to increased operational risk. And this has been the case all along. So there is nothing new. We aren't doing anything new. What we are doing now is to put a layer of controls, systemic controls around it, such that where the branch manager is providing that discretion and service, the system has methods of ensuring that those are done properly. So only to people whose accounts are reasonable will an account excess be authorized, which is a temporary overdraft credit or something of that kind, will only be authorized to people who have a specific score. Now, this is a work in progress. We don't believe that structurally we should move to a centralized structure, because then our ability to compete with the HDFCs and Kotaks of this world will get limited, because by definition we are a smaller institution. But we need to ensure that there is sufficient operational control on these decisions at the branch level. And that is something that we are working on along with the digital transformation project. So I do apologize if we gave the wrong impression in the slide. Yeah.
No. So just to get it correct, we will have still more empowered branch managers. In just that we have put in the several layers of compliance and our operational filters, right?
That's right. Systemic filter. Supposing you're a customer. Let me put it this way, boss. Let's say you have an overdraft account with us, okay? And you're a businessman, you have a 1 crore rupee limit, and then your business is at its peak. And in April, May is when your maximum business happens. You come to the branch and say, look, I need 10 lakh rupees of incremental credit for 2 weeks. Now, historically, the branch manager would take a look at you. If he knew you well and he knew your business, he could say yes. But now what we are doing is we are putting a system. The system will score the customer and will say, okay, for an excess. Is the customer okay? Then it will approve him. If he's not okay, the branch, it will turn him down. So that systemic control is what we are building. We are not, the branch manager remains empowered. It doesn't have to be referred anywhere. But all the decisions will have a systemic filter on it.
Sure, sir. And this is still, if I remove the, let's say, large private banks, but then, at other smaller private banks like South Indian Bank or Karnataka Bank or, other banks, they still have, they are probably have moved to the vertical framework, right, where the branch manager would not have much discretion. So this probably would put us in a different, let's say, customer experience, because our branch managers would be more empowered.
That is right. That is that's the reasoning.
Sure, sir. And sir, just sorry about the asset quality piece again. So this S4A of 79 crores, is this included in 325 crores or is still outside that watch list?
The 5 bar 55 is not 5 bar 25. 5 bar 25 is the one that's not included. Sorry, I misspoke. It's not the S4A, it's the 5 bar 25 which is not included. 76 is not included.
So S4A is included and 525 is not included.
Correct. My apologies.
Sure. And sir, just on, if I see our incremental slippages this quarter in commercial, except corporate book. So that is, if I just annualize, that is roughly around 1% or 75 crores quarter and, 300 crores kind of an annualized number. Do you think that is more kind of a, normalized slippages rate except corporate book, or there is still or there is some unusual, in this figure?
On the commercial side, if you were to look at it over the last 2 or 3 quarters, it's increased a little bit in this quarter. We think that if you go back a couple of quarters, we were running at 60 basis points, then we were running at 90 basis points, and now we're running at 156 basis points. I suspect that there will be 1 or 2 quarters of slightly elevated loss levels on the commercial side as we flush through some of the older assets. But having said that, our agriculture and retail continues to perform really well. So on an aggregated basis, we think that we should renormalize to about 150 basis points, starting from the next quarter onwards. We'll slowly go back. Right now we are at 512 basis points. We should start trending sharply towards the 150 basis points.
So 150 would also include your corporate kind of a slippage number?
Yes.
Sure, sir. And sir, just lastly, if you can provide, your expectation of, loan loss provisioning for FY19, considering NCLT and your estimated level of PCR that you would like to have by FY19. So just that would be much helpful.
Separately. It's off the cuff. I haven't really thought that through at this point in time. I'll request Mr. Shriram Prasad to actually work that out and share it more widely if possible.
Sure, sir. No issues. Thank you so much.
We'll do that.
Sure, sir.
Thank you. The next question is on the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Thank you, sir, for the opportunity. If we leave aside the last 3-4 years from FY14, the ROA of the last 10 years on an average was around 1.5 for Karur Vysya, and ROE is at around 18 to 19%. When do you see we moving back to that trajectory? What is the timeline you have?
So my own view is, if you were to look at our numbers, our pre-provisioning operating profit is roughly 1,800 crores today. For us, if we can bring our NPA down to 150 basis points, which is 750 crores, or let's say on 45,000 crores, 630 crores or so, incremental NPA for the year, and which means that we need about, let's give or take about 400 crores of provisioning. That will bring the profit before tax to about 1,400 crores. And the tax will be roughly 500 crores at that level, and you would be at about 800, 900 crores of profits. So that entire driver for the P&L is actually the, renormalization of the NPA. And if we can get profit after tax of about 800 crores, we are looking at roughly 1.2, 1.3% return on equity. So we think that our NPA levels will continue to be elevated for this quarter, this particular Q1 of this fiscal. They will taper off in Q2, and if all goes well, they'll continue tapering through Q3 and Q4. And I suspect in Q3 and Q4, if all goes well, and if we don't have some things that come and bite us suddenly, we should be closer to the return on assets that I was just talking about. But that is contingent upon the loss numbers renormalizing back towards the 150 basis points level. So we are looking at Q3, Q4 as the point where they renormalize, and then by which time all our digital efforts will have also started giving us fruit, and things will look very different thereafter.
And you are comfortable with the current margins? Do you think margins are likely to be under pressure, or 3.5% plus are kind of sustainable given the move towards lower ticket size loans?
I think we have room in the margins. That's my view. Unfortunately, whilst the NIMs in this quarter have been very nice, they have been aided by a one-time revenue that was recognized by us. But we think that there is a lot of room in the NIM, and we can improve NIM. There is pricing power available in the marketplace, which we are in the process of exercising.
And so
that will happen slowly. Yeah, go ahead.
So finally, I got a little confused with the various watch lists, what is included and not. If you can just repeat, a watch list is 325 crores, and what part of watch list is lying in restructured and what part is not lying, and where are SDR and S4A in watch list?
Watch list is 325 crores. Out of that 325 crores, roughly 50% is funded, 50 is not. Roughly. I mean, these are not exact. Sure. Ballpark. As the unfunded ones, as the funded ones become NPAs, we will create provisions for them. On the unfunded ones, we will create provisions on the basis of our expectation of them being called. Okay? On our expectation of when they will be, when those guarantees or letters of credit will be invoked. With respect to the restructured book, many of these assets have been impacted by the February 12th circular. Now, 175 crores worth of these assets, which were earlier restructured, were provisioned this quarter, in Q4. An incremental 200 crores or so will require provisioning in the near term on account of the fact that the entire restructuring process is now in abeyance. So the 200 crores is outside of the 325 crores. The 325 crores consists of two parts, funded and non-funded. The funded bits will require provisioning immediately. The non-funded bits we'll have to build provisioning over time as we try and figure out as to when they will be called. So we have some time on building the provisions on those. Some of those may not necessarily be called also. I mean, it depends upon what happens, with bank guarantees. If a project is going well and it's being delivered largely, the guarantee need not necessarily be called. So that's the position. I hope that clarifies.
And S4A and 525, are they lying somewhere in restructured and watch list, or they are separate?
These are separate. The entire 262 crores in restructured and the 5/25 of 76, these are separate. The S4A account of 79 is part of the 262.43. They do not feature in the 325 crore watch list.
Okay. So S4A is part of restructured, basically?
Yes.
Okay, thank you, sir. That was very clear. Thanks.
Thank you.
Thank you, mate.
The next question is on the line of Dhaval Gada from Sundaram Asset Management. Please go ahead.
Yes, sir. Just one follow-up on the NCLT exposure. Could you just give our latest NCLT list 1, list 2 exposure provisioning, and outside of list 1 and list 2, if we have any NCLT cases as well?
I thought the NCLT-related questions were over. So the gross total NCLT-related list 1 and list 2 together was roughly 1,196 crores or 1,200 crores. The provision, we are holding roughly 40% provision. We need to make another 70 crores provision during this quarter, which is disclosed in one of the pages here in the deck.
Yeah.
So we... with respect to any other account that may be going through an NCLT process, I am not in a position to answer that question right away because I don't have the information. I'm scared that I'll say something wrong. So if you could revert on that.
Sure, we'll do that. We'll do that. Yeah, no problem. Thank you.
Thank you.
Thank you. The next question is on the line of Harsh Desai from Valum Capital. Please go ahead.
Hi, so my question was related to lending to corporates. Now that PSUs have become a little more conservative in lending to corporates, don't we think we can look at growing a good quality corporate book, or we're still going to concentrate more on retail and ignore the corporate book altogether?
Thank you. I think it's a very good question, and we've been having that debate internally as well. We have always said that we will continue to grow the corporate book, but we want to redefine the corporates and cap our exposure. So our corporates are not the top-tier corporates who have tens of thousands of crores of borrowing from the banking system, but smaller institutions. With maybe 300-400 crores worth of loans from the banking system, where we put out, we cap our exposure at about 100-125 crores. And, we don't want to be members of large consortiums where we have limited ability to influence the outcome. So we've made some changes. We would like to continue to grow the corporate book. We would like to grow it a little slower than the commercial and agricultural and retail book, so that, its overall share in our book continues to decline. As you would have seen, it's come off from about, from 37% to 31% now. But having said that, it's been growing. We will continue to grow it with a focus on quality, with a focus on, structures that are self-liquidating. So a more intelligent method of lending to bankers, to corporates, such that we protect ourselves. And our new Chief Risk Officer is an expert in corporate lending, so we don't want to let go of his expertise, but to benefit from it.
Mr. Desai, I would like to add, see, our corporate, anything above 25 crores of lending or anything above 150 crores of turnover is treated as a corporate. It is actually a mid-corporate or a small corporate in case of many banks.
Yeah. Okay, but and just another thing on your fee income, are we looking to add any more insurance companies in distributing their insurance products, or are we going to stick with what we have? And what is our outlook on our fee income and its growth in that sense? Are we taking on any new partners?
Yes, we are. We've basically doubled our gross received premium on the life insurance side year on year, almost doubled. And now we believe that we have enough to interest a second partner. So we've got an RFP out there to seeking other partners who may be interested in doing business with us, and we've got a lot of people who've written in already. Similarly, on the health side, we didn't have a partner. So we were using our existing partners' general insurance license to sell health products. And now health products have become, premiums are almost as large as life insurance premiums. So we are now, we just concluded an RFP to appoint health insurers, and we are taking 2 on board. And finally, we will, expand the set of general insurers that we do business with as well. We currently have 1. We will be floating an RFP and increase that number to 2. So that we can optimize our product set and ensure that our customers get the best value.
Okay. And are you all in a position to disclose who these 2 health insurers will be, or who the life insurer will be?
It would be best done if we, conclude this. Whilst the health insurance bits are concluded, we haven't really signed the agreement with them yet.
Okay.
So it would be inappropriate for me to disclose it at this stage.
So can we say our growth this year in fee-based products will be much better than last year because of all these new partnerships?
That's the idea. And we've also created a new third-party sales force. These internal people, approximately 90 of them, fully trained, who their job, historically the life insurer and the general insurer had his own people helping our branch staff sell these products. But now we put our own people there, in addition to the life insurance folks. The idea is that our chaps will know our branches better, can talk to our customers as employees of Karur Vysya Bank, and leverage the goodwill that we have and sell products that our customers need. So this sales force went live in April, and we expect that also to start paying off because, this is a fairly substantial sales force, and they are people who are embedded within our company. They are our own employees, officers with about 4 or 5 years of experience. And, they, together with the life insurance sales force, should start showing us some, lift in the sales numbers. And as I said, life insurance sales almost doubled year on year. 2000 last full year versus the prior full year, we doubled. And most of the growth came in the last 6 months of
and was that backed by a lot of credit life, or what was it backed by?
We don't do any credit life.
No, don't do any credit life. But do you think that's a big opportunity that you all can have with your home loans if you all can
I used to work in Citibank, and thereafter I was in the UK, and I have seen what happens with credit life sales. Having said that, we are examining it. There are sales-related issues on credit life, as you're aware. The UK banks had put together, provisioned about 35 billion pounds on credit life sales. Having said that, if the market allows it and if the regulators are okay with the sales practice, then we should start looking at it, and we will do that in this quarter or the following quarter.
All right. That's it from me. Thanks a lot.
Thank you.
Thank you. The next question is on the line of Pranav Gupta from HDFC Securities. Please go ahead.
Hello.
Yes, Pranav, please go ahead.
Yes, sir. So you mentioned that the growth in CASA is without any differential pricing that you do, and you also mentioned that you're looking to launch a digital bank just like Kotak. So with the headroom available in increasing lending rates and pricing power that you have, would you look to increase SA pricing going forward?
Every month we do the exercise of looking at our own portfolio and seeing what happens at different price points. But with the new digital platform, we need to start thinking whether that it makes any sense to offer a differentiated price for certain categories. So that is something that we are looking at. I don't want to say one way or the other as to whether we're going to do it or not.
Okay. And secondly, just a data point, could you give me the risk-weighted assets number?
Risk-weighted assets should be in the neighborhood of, usually,
One second.
Do we have it in this deck or it's in the other deck? Why don't we come back to you with the risk-weighted assets number? Just give us a minute. We'll just look
Just give me a minute, Pranav. I'll inform you.
Okay. Yes, no problem, sir. Thank you. That's it from my side.
Thank you. Next question is on the line of Madhuchanda Dey from MC Research. Please go ahead.
Hello.
Yes, please go ahead.
Yeah. You have articulated the new strategy for the bank. So, in terms of the customer segment, is there anything new that we can expect in the coming 1.5 to 2 years in any new business, any new initiative from your side?
Ma'am, from a customer segment point of view, there is not much change. We are a retail deposit taker and a commercial stroke corporate lender. We are becoming a more, we are trying to play in the retail lending space as well. On the commercial side, we want to launch a bunch of new products, including a commercial credit card, which hopefully we should do by the end of this year or a little earlier than that. That's essentially because we have a large number of commercial customers who perhaps are not serviced by the current credit card providers. So from a segment perspective, there's no change. We want to become more relevant and more contemporary to younger people. So one of the issues that we do have as an institution is that our depositor base tends to be a little older. The older people also tend to have more money to keep as deposits, but having said that, it's a little older than the average for the country, and we want to bring the age profile of our customers on the depository side lower, and that can only happen if we can appeal to the younger customers through products and services that they are willing to use. And that's the reason why the digital bank initiative has been undertaken. I hope that answers your question.
Yeah. The second question, again, many of the participants have asked this already, but just to get a clarification, your target is to get the slippage to an annualized run rate of 750 crore. And you also mentioned about the watch list and the restructured book. So, is it reasonable to assume that by the second half of this year, FY19, we are going to hit this 750 crore, but there would be an incremental slippage of ballpark 400 to 500 crore in addition to this run rate in the first 2 quarters? Is it a reasonable expectation?
It is reasonable to expect that the first quarter, this quarter, and the following quarter will be more elevated than the 750 levels, ma'am. And it will progressively taper off. That's the current expectation, to the 750 or 150 basis points
right.
NPA. Yes.
Okay. And so in the first half, what kind of slippage are you guiding to on the basis of the assessment of your existing stress book?
We are not at this point in time providing explicit guidance other than the fact that we expect it to be elevated during this period between the first and the second quarter. I mean, just the first quarter. Second quarter the normalization process should start. We don't expect the corporate book to have significant slippages starting the second quarter onwards. So that should sort of give you some indication, given the nature of the slippages that we have in our book. Since about 80% of our total slippages come from the corporate book, if the corporate book renormalizes and there is no significant uptick in the there's no significant slippage in the corporate book starting the second quarter, then it should give you an indication of where our numbers will lie.
Okay, that's helpful. And one last question, in this rather competitive landscape where everyone is chasing very good quality credit, CASA is a key differentiator in the system. So while there has been a decent ramp up, but still you are lower than many of the, private sector peers. So what is the kind of target on CASA can we expect from you, maybe in a years down the line or 2 years down the line?
We want to be north of 31.5% at the end of this year, if we can be. Now, CASA largely comes, ma'am, from, if you were to look at different banks, corporate banking is a big source of CASA. Transactional banking groups where, for bigger banks like HDFC Bank and Citibank and so on and so forth, are major engines for CASA. Unfortunately, we don't have those. Our transaction banking group is a nascent one, and we are trying to push that as aggressively as possible. So most of our CASA comes from normal retail, granular customers. So that has some advantages. It is less volatile than CASA that is based on the corporate banking side. But having said that, it's also more difficult to build. So our view is that, we will continue pushing against this. We'll try and get it north of 31, 32%, at the end of this year. But we will come to a point where further push may be difficult, and strategically we'll have to do something different. And one of the things we're doing is this new digital initiative. Hopefully will enable us to grow a little bit more. We'll have to double down on the transaction banking business that we launched about 3 or 4 years ago, which we haven't really scaled. We'll need to put some good people and push that so that we can start driving some business-related CASA. But CASA is not going to be an easy one for us to grow. It's going to be a difficult one, and we'll have to keep pushing against that so that we continue to build from where we are.
Okay. And just one last question. You had mentioned that you have so far not used the differential pricing on the SA side. So is that also on the cards?
We are debating it as we speak, whether to go there or not.
Okay. Thank you very much.
Thank you.
Thank you.
Yeah, Pranav, are you there?
He can't answer.
Mr. Pranav?
You just answer the question.
Mr. Pranav, you asked about the total risk-weighted assets. It is around 44,139 crores. That is the total risk-weighted assets. Both credit, market risk, and as well as the operations risk together. Yeah, ma'am, please go ahead.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Abhinesh Vijayaraj for his closing comments.
Thank you, Lizanne. On behalf of Spark Capital, I thank the investor community for dialing into today's call. I'd also like to specifically thank the KVB management team for taking time out and patiently answering all our questions. Good day, and thank you.
Thank you.
Thank you.
Thank you.
Thank you very much.